Welcome to the Pro Ticker Deep Dive.
It's great to be here.
I was looking at the story of 2025 for Air Canada, and if you were to write it as a movie script and pitch it to a studio, they'd probably tell you it's too unrealistic.
Oh, absolutely. They'd say, pick one crisis, you can't have them all.
Exactly. You start the year with record-breaking cold, record snowfall, basically freezing operations solid. Then, just as things thaw out, you're heading into summer, boom, a massive labor disruption right at the peak of travel season.
It's the kind of year that usually ends with a CEO giving a very somber press conference and apologizing for, everything.
Right. And usually when we sit down to look at a year like that, we're basically performing an autopsy. We're talking about huge losses, a lot of excuses, headwinds, and the classic, we'll do better next year.
That is the standard airline industry playbook. It's a business with such high fixed costs and, incredibly fragile operations. If one thing goes wrong, let alone 3 or 4 huge things, the whole house of cards can come down.
But that's not what we're talking about today, and that's what makes this so interesting. We're looking at Air Canada's 2025, and it was, on the surface, just a complete roller coaster, all that chaos. And yet, when the dust settled, when they closed the books on the fourth quarter, the story wasn't about survival at all.
No, it was about records. It's a fascinating case study in what you might call operational resilience. You look at the headlines from August, and you just see turbulence.
Right.
Chaos. But then you look at the balance sheet from December.
And you see clear skies.
Precisely.
And that's the tension we really need to dig into today. How does a legacy carrier, a big established airline, swing from a massive loss, and I mean an eye-watering loss in Q4 of 2024, to a profit of almost $300 million a year later?
And in an environment where costs are going up for everybody. Inflation is sticky, things are unstable all over the world. It's not an easy time to be flying planes.
So that's our mission for this deep dive. We need to figure out how they did it. How do you navigate a year with that many headaches and come out with a record-breaking financial performance? And the big question is, was this a fluke? Was it just pent-up travel demand, or did something fundamentally change in how Air Canada makes money?
That's the key, right? Is it a cyclical thing that'll just fade away, or is it a real structural shift in the business?
Exactly. And for anyone listening who watches the markets, we have to tackle the big question for 2026. Management is calling it a transitional year. So is this a buying opportunity, or is it a wait-and-see moment?
Which is the classic dilemma. Do you bet on the record results you just saw, or do you get nervous when you hear the word transition? Because in the airline world, transition can sometimes mean, burning a ton of cash.
Okay, before we dive deep, let's just tease the big headlines, because the numbers themselves really set the stage here. We're talking about a swing from a $644 million loss in the fourth quarter of 2024.
A loss.
Yes, to a net income, a profit of $296 million in Q4 2025.
That's nearly $1 billion turnaround in just the quarterly comparison. For a mature airline, that's almost unheard of outside of some kind of bankruptcy restructuring.
And also going to talk about the secret sauce, which sounds like something out of a spy novel, The Sixth Freedom Strategy.
It sounds very mysterious, but it's really just about smart geography. It's the business of flying Americans over Canada to get to other places, and it is a huge, huge deal for them right now.
And then there's a term that sounds like it belongs in an economics textbook, the Dutch auction. We need to unpack what that is and why Air Canada used it to buy back a ton of its own stock.
A very aggressive and I think very telling move to reward shareholders. We'll break down exactly how that works.
And finally, for all the EV geeks listening, and I know you're out there, we have to talk about the new planes. The Airbus A350-1000s are on the way.
The future flagship. Yeah, it's a big deal. It signals a major shift in their long-haul thinking.
All right, let's get into it. Let's start with the money. Section 1, the financial turnaround. That Q4 swing, it's just so dramatic, we have to start there.
It is, and the context is so important. That $644 million loss in Q4 2024, that wasn't a small miss. That was a serious problem, a bleeding wound. So to flip that to a positive $296 million, it's not just about, tightening your belt.
Right, you can't save your way to a $1 billion swing. It's not like you just stop serving peanuts and suddenly you're rich.
Exactly. You could stop serving meals entirely and you still wouldn't bridge that gap just on cuts. This was driven from the top line, from revenue. They hit a record $5.8 billion in operating revenue for the quarter, up almost 7% from the year before.
So what's the story behind that revenue? Is it just higher ticket prices across the board?
It's about the quality of the profit. Sometimes a company posts a big profit because they sold off a building or got a one-time tax credit. That's what we'd call low-quality profit. An investor looks at that and says, okay, great, but can you do that again next quarter?
And that's not what this was.
Not at all. This was from the core business. This was passengers buying tickets. This was planes flying full. And the earnings per share, the EPS, tells the story perfectly. In Q4 2024, for every single share of Air Canada stock, the company lost $1.81.
Okay.
A year later, in Q4 2025, for every share, they made $1.
That is just a massive psychological shift. For an investor, you've gone from owning a piece of a money-losing operation to owning a piece of a money-making one. It changes the entire story.
Completely. It moves the stock out of the sort of distressed asset category, where you're just betting on survival, into a growth and value story, where you're actually betting on the earnings power of the company.
And if we zoom out to the full year, does the picture still look as good?
It does. Total revenue for all of 2025 hit $22.4 billion.
$22.4 billion.
Yeah.
But you always tell me to look at a different number, the adjusted EBITDA. Remind us again why that's the one you focus on for airlines.
Because net income, the final profit number, can be really noisy in this industry. Airlines have huge debt, so interest payments can swing around. They have billions in assets. The plane's SO depreciation is a massive non-cash expense. EBITDA, earnings before interest, taxes, depreciation, and amortization. It just cuts through all that accounting noise.
And asks one simple question.
Is the actual business of flying planes making money?
And for 2025, the answer was
a resounding yes. It landed at $3.1 billion for the year.
$3.1 billion.
And here's the really interesting part. That number actually beat their own guidance. Remember, back in August with the labor disruption, they had to suspend guidance. They were basically flying blind. When they finally put out a new forecast, they said they'd land somewhere between 2.9 and 3.1 billion.
And they hit the very top of that range.
Yeah, they hit the top end. Despite the strikes, despite the winter storms, they over-delivered. That tells you there's a certain conservatism in how they're forecasting, which the market tends to like. They're not over-promising.
So let's talk about the bank account. Because in this industry, cash is everything. It's oxygen. You can look profitable on paper, but if you run out of cash, the planes stop flying. We saw that in 2020. So are they burning through cash to get these results?
Quite the opposite. This is what we now call a fortress balance sheet. They generated $3.7 billion in cash just from their operations. And the free cash flow? That's the cash left over after you've paid for all the big capital projects like engine overhauls and new parts. That was $747 million.
So they're not burning cash, they are actively piling it up.
Piling it up. They ended the year with $7.5 billion in total liquidity.
Okay, $7.5 billion. Let me play devil's advocate. Why do they need that much? Couldn't that money be used better elsewhere, like paying a huge dividend? Is that just hoarding cash?
In any other industry, maybe, but in the airline industry, absolutely not. Think about March 2020. Think about August 2025. Revenue can literally shut off overnight. It can go to zero.
But the bills don't stop. The leases on the planes, the salaries, the debt payments.
Exactly. Those all keep coming. That $7.5 billion is an insurance policy. It means you can weather a massive storm, whether it's a pandemic or a volcano erupting or a war, without having to go begging to the banks for an emergency loan at a terrible interest rate. It gives you flexibility. It's the difference between living paycheck to paycheck and having a year's salary in the bank.
That lets you think long term instead of just surviving until next Tuesday.
That's it, exactly.
Okay, so the financials are strong. But we can't tell this story without talking about the rough patches. We have to contextualize this success. So let's pivot to section 2. You cannot talk about 2025 without talking about the summer slump.
The elephant in the room. We have to go there. It was, in many ways, the defining moment of the year.
This was the labor disruption with CUPE, the Union for the Cabin Crew. Just remind us what happened in August.
Well, for an airline, there is literally no worse time for a work stoppage than August. That is the absolute peak. Families are on vacation, students are flying back to school. It's when you make the money that gets you through the slow months in the winter.
That's the harvest.
It is the harvest. And suddenly you have the threat of a strike. And, the threat of a strike is almost as damaging as the strike itself.
Why is that?
Because of uncertainty. If you're planning your big family trip to Europe, the one you've saved up for years, and you see on the news that Air Canada might have a strike, are you going to book with them?
No way. Not a chance. I'm going with a different airline immediately. I'm not risking that.
Exactly. So bookings just fall off a cliff. People book away to competitors. And then, as things got tense, Air Canada had to start proactively canceling flights. You can't just wait for a strike to happen and have all your planes and crews stranded in London or Tokyo. You have to start bringing the operation down safely.
And the numbers were huge. How many flights are we talking about?
Around 3,200 flights were canceled, just gone. That's tens of thousands, maybe hundreds of thousands of passengers who had to be rebooked, refunded, or were just left stranded. You saw the pictures at the airports, the chaos.
What was the financial hit from all that?
The estimates put it at about $375 million, just wiped off the operating income and EBITDA.
$375 million. That's not a rounding error. That's a huge number.
It's a massive number. And frankly, if that hadn't happened, we'd be talking about an even more historic year for them. That $3.1 billion in EBITDA we were just celebrating, it would have been closer to $3.5 billion.
Wow. That really puts this success in perspective, doesn't it? It completely destroys any idea that 2025 was just an easy year of post-pandemic travel. They posted these incredible numbers despite taking a nearly $400 million punch to the gut in their most important quarter.
It does. It shows you how strong the underlying demand and their pricing power must have been to absorb that kind of hit and still come out so far ahead. Usually, a Q3 strike would wipe out an airline's entire profit for the year. In this case, it was a speed bump.
But there's a cost that lingers even after the disruption is over, right? And that brings us to my favorite airline acronym, CASM.
Ah, yes. CSM, cost per available seat mile.
Okay, let's break that down for everyone. It's basically their unit cost, right? How much it costs to fly one single seat for one single mile.
That's it. You take all your costs, fuel, salaries, maintenance, everything, and you divide it by your total capacity. It's the ultimate measure of an airline's efficiency. The game is to keep your CASM low and your revenue per seat mile high.
And the news on the cost front is, well, it's getting more expensive to run an airline.
It is. Their adjusted CSM was up 6.7% over 2024. It's now at 14.72 cents.
Almost 7%. That's a big jump. Is that a cause for concern?
It's significant. And when you look inside that number, you can see exactly where the pressure is coming from. The biggest single piece, about 270 basis points of that increase, is from labor.
The new union contract.
New contracts with the pilots, with the cabin crew. That means higher wages, better benefits, and that's a structural change. Those costs are now baked into the business going forward. You don't undo a wage hike.
But I guess on the flip side of that.
On the flip side, you get labor peace. You pay more, but you avoid another August 2025. You get stability and predictability for the next few years. And investors, they hate uncertainty even more than they hate high costs.
So it's an investment in a stable operation. You take on a higher cost base to protect your revenue.
That's the trade-off. But it wasn't just labor. You also had the one-time costs from the disruption itself, paying for hotels, overtime, all that chaos. And then there's just general inflation on maintenance.
Parts are more expensive.
Parts are more expensive. Getting skilled mechanics is more expensive. The global supply chain for aviation parts is still not back to normal. So it's a tough environment on the cost side, for sure.
Okay, so costs are up. But as we established, revenue is up even more. So let's get to the fun part. Section 3. How do they do it? How do they make so much money? You teased it earlier. The sixth freedom strategy.
This is the real story. This is the cornerstone of their international growth.
I love this term. It sounds so official. So the freedoms of the air are actual international treaties, right?
They are, yeah. They go all the way back to 1944. But the sixth freedom, in simple terms, is the right to carry a passenger from one foreign country to another foreign country as long as you stop in your home country along the way.
Okay, put that in plain English for me. Give me an example.
Plain English. It means Air Canada can sell a ticket to an American in Boston, fly them to Toronto,
Okay.
and then fly them from Toronto to Rome. The journey didn't start or end in Canada, but Canada was the bridge.
Ah, I see. So they're basically using their geography.
Exactly. If you look at a globe, the shortest path between a lot of U.S. cities in Europe or Asia actually goes right over Canada. It's called the Great Circle Route. So Air Canada's strategy is to siphon off traffic that would have otherwise flown on United or Delta or American.
But why would an American traveler choose to connect in Toronto instead of, say, Chicago or New York?
A few reasons. Price is one, they can be very competitive, but a big one is just convenience. If you don't live in a giant hub city, say you live in Pittsburgh or Cincinnati, You have to connect somewhere anyway to get to Asia.
Right, you're not flying direct.
So your choice is, do I connect through a chaotic, often delayed airport like JFK or O'Hare, or do I have a smoother connection through Montreal or Vancouver? And there's another huge advantage.
The customs pre-clearance.
Bingo. On your way back to the U.S., you clear U.S. customs and immigration inside the Canadian airport. So when your plane lands in the States, it's treated like a domestic flight. You just get off, grab your bag, and go home. No 2-hour line at passport control at JFK after a long flight. It's a massive selling point.
And is this strategy actually working? Is it moving the needle?
It's not just moving the needle, it's become the whole engine of growth. In the fourth quarter, international markets drove 90% of their revenue growth.
90%, wow.
It's staggering. It's not people flying from Calgary to Winnipeg that's driving the profit. It's people flying from Denver to Delhi via Toronto. Their Pacific traffic, just as one example, grew 25%. They are aggressively going after this market.
And it makes them less dependent on just the Canadian economy.
Yeah, that's the strategic genius of it. It decouples their fortunes from Canadian GDP to a certain extent. They have this huge flow of US dollars coming in. They're not just a Canadian airline anymore. They're a North American super connector.
But it's not just about getting people on the plane. It's about which seats they're sitting in. This brings us to the premium cabin and loyalty.
Right. You want to sell that expensive seat at the front of the bus. That's where all the profit margin is. And their premium revenues rose by 2%, which actually outpaced the growth in economy.
So people are willing to pay up for the better seat. Is this just leisure travelers treating themselves, or is business travel finally back?
It's a mix, but what we're seeing is that premium travel now makes up about 30% of their total passenger revenue. That's a very, very healthy number. You can absorb a fuel price spike much more easily if you're selling $5,000 tickets instead of $500 ones.
And I saw a really interesting stat in there about corporate travel. For the longest time, the narrative was Zoom is going to kill business travel for good.
That was the story for 3 years. Every airline investor was terrified of it.
But it looks like that's not what's happening.
It's not. In Q4, their corporate revenue was up 8%, a late-year surge. It suggests companies have decided that face-to-face meetings matter. You can't close a big deal over a video call as well as you can over dinner. And that's the lifeblood for legacy airlines because business travelers buy those expensive, flexible, last-minute tickets.
And then there's the other cash machine, Aeroplan.
The loyalty program. It's amazing how much people underestimate the power of these programs. It's a high-margin, incredibly stable business. Their third-party gross billings were up 7%.
And what that means is people are using their Aeroplan-branded credit cards to buy everything from groceries to gas.
Exactly. And every time you swipe that card, the bank that issued it has to buy miles from Air Canada to put in your account. So Air Canada gets a steady stream of high-margin cash that has nothing to do with whether a single plane takes off. It doesn't care about the price of jet fuel. It's an anchor for their earnings.
It's almost like they're a credit card company that just happens to fly planes on the side.
In many ways, that's what a modern airline has become.
One last piece of the strategy puzzle, cargo. We all saw the pictures during the pandemic of planes with boxes strapped into passenger seats. Is that still a meaningful business now that people are flying again?
It is. It's stabilized as a real standalone revenue stream. It's not just a pandemic stopgap anymore. Air Canada Cargo brought in over $1 billion in revenue, and in Q4, cargo revenue was up 20% year over year.
That's strong growth.
It is. And they have dedicated freighter planes now. It's not just about using the belly space on passenger flights, so it's another lever of diversification. If passenger demand softens, maybe cargo demand stays strong. It makes the whole enterprise more robust.
Okay, so they're making money from everywhere. International passengers, premium flyers, credit cards, cargo. So what are they doing with all this cash? That brings us to Section 4, shareholder returns, and the very strange sounding Dutch auction.
Yes. This is a really important part of the 2025 story. It tells you a lot about how management sees the value of their own company.
Let's set the stage first. During the pandemic, airlines were desperate for cash to survive. And they got it by issuing millions and millions of new shares of stock.
Dilution. It's the enemy of the long-term shareholder. If you owned 1% of the company in 2019, by 2022, you might have only owned, say, 0.5% because they just created so many new shares. Your slice of the pie got a lot smaller.
Right. So now Air Canada is actively trying to reverse that damage. They want to shrink the pie again so that everyone's slice gets bigger.
That's a perfect way to put it. They have a stated goal to get their share count below 300 million by 2028. And to do that, you have to buy back your own stock aggressively.
So in mid-2025, they did this substantial issuer bid using a modified Dutch auction. Okay, explain this to us like we're not finance majors. Why do it this way? Why not just buy shares on the stock market like everyone else?
It's about getting a large amount of stock quickly without driving the price up against yourself. If they just went on the open market and said, we want to buy $500 million worth of stock, the price would shoot up instantly.
Okay, so how does the Dutch auction work?
Imagine they put $500 million on the table and they go to all their shareholders and say, we want to buy your shares. You tell us the price you're willing to sell it, but it has to be within this range. I think it was between $18.50 and $21.
So I'm a shareholder. I can say, I'll sell my shares for $20.
Right. And someone else might say, I'll sell for $18.50. I just want out. Someone else might say, I'm holding out for $21. Air Canada collects all of these offers.
Then what?
They stack them up from the lowest price to the highest, and they start buying, starting with the cheapest offers first. They buy all the shares offered at $18.50, then $18.60, and so on. They keep moving up the price ladder until their $500 million is all spent.
And the price of the last share they buy becomes the price for everyone.
Exactly, that's the clearing price. In this case, it ended up being $18.80. So everyone who offered to sell for $18.80 or less got their shares bought back at that price. If you offered to sell at $19, you were too expensive and none of your shares were bought.
What was the result? How many shares did they take out?
They bought back and retired about 26.6 million shares. Just poof, vanished from the market.
Which automatically increases the earnings per share for all the remaining shares.
Mechanically, yes. Your E in EPS, the earnings stays the same, but the S, the shares, goes down. So the whole ratio goes up.
And they weren't done there.
Not even close. That was just the start. They then launched a standard buyback program, an NCIB, to go and buy another 29.5 million shares over the next year.
So all told, since 2024, they've taken over 64 million shares out of circulation.
It's an incredibly aggressive return of capital. And it sends a very powerful signal.
Which is?
Management thinks their stock is cheap. You don't spend billions buying back your own stock if you think it's fairly valued or expensive. You do it when you believe it's a bargain. They're betting on themselves.
So 2025 was a spectacular turnaround. They're flush with cash. They're buying back stock. But now we have to look ahead. Section 5, the outlook. Management uses this word, transitional, to describe 2026. And usually when I hear a CEO say transitional, I get nervous. It's often code for profits are about to go down.
It can be. It's often corporate speak for a soft patch, or we're fixing some things, bear with us. But in this case, I think it's more about heavy investment.
Because when you look at their actual financial guidance, it doesn't look like a slump at all.
It doesn't. They're guiding for adjusted EBITDA to be between $3.35 billion and $3.75 billion.
Wait a second. They just did $3.1 billion in 2025, so they're forecasting growth in their transitional year?
Exactly. So it's not a transition in profitability, it's a transition in operations. They also plan to grow their capacity, the number of seats they fly, by another 3.5% to 5.5%.
But the free cash flow guidance looks a bit lower, 400 to 800 million. Why the disconnect between rising profit and flatter cash flow?
And that's where the transition and the investment piece comes in. CapEx. Capital expenditures are going way up. They are spending money on the future.
On new planes.
On new planes, on retrofitting existing planes, on technology. When you're writing big checks to Airbus and Boeing, that comes directly out of your free cash flow. So you're taking a short-term hit to cash flow to set yourself up for long-term growth and efficiency.
And the cost headwinds are still there. CFM is expected to keep climbing to over 15 cents.
Yes, the cost pressures aren't going away. So the bet is that their revenue growth, driven by that international and premium strategy, can continue to outrun their cost inflation. It's a race.
Let's talk about the new toys then. The fleet modernization. This is the exciting part. The Airbus A350-1000.
The new flagship. It's a fantastic aircraft, incredibly fuel efficient, very long range, and a great passenger experience. They've ordered 8 with options for 8 more. This is the perfect plane for that 6th freedom strategy, flying long, thin routes from Canada to deep in Asia or Europe.
And these decisions are being made now for planes that won't even arrive until 2030.
Aviation is a long game. You're always planning a decade out.
There's also a big change happening with Rouge, which is their leisure airline.
Yes, and this is a big part of the 2026 transition. They're moving the entire Rouge fleet over to the Boeing 737 MX.
Which is a much more fuel-efficient plane than the older Airbuses they've been flying.
Much more. Huge savings on fuel. But swapping an entire fleet is a complicated, expensive, and disruptive process. You have to take planes out of service. You have to retrain every single Rouge pilot because an Airbus pilot can't just jump in a Boeing cockpit. It's a completely different system.
And while those pilots are in the simulator training, they're not flying and generating revenue.
Exactly. That downtime hurts your efficiency metrics for a year. It's a short-term pain you have to endure to get the long-term gain of a more profitable fleet for the next 15 years. That's the transition.
Makes sense. Okay, so how does the market see all of this? Let's talk valuation. Is the stock cheap or expensive right now?
Well, it's trading around 1940 Canadian. And if you look at the standard valuation multiple for airlines, which is EV to EBITDA, Air Canada is trading at roughly 5 times.
5 times.
Mm.
How does that compare to its peers?
It's a huge discount. If you look at the big U.S. carriers, Delta trades at around 8 times EBITDA. United is at about 7 times.
So there's a pretty big gap. Why? Is it just the Canada discount that we see in some sectors?
That's part of it, but this gap is wider than usual. I think there's still a bit of a hangover from the pandemic, from the government involvement. Some investors are still wary, but the analysts who cover the stock are mostly scratching their heads at the low price.
What are their price targets?
Almost all of them are significantly higher. You see targets of 24, 25, even 26.50 from the big Canadian banks. The consensus is generally a moderate buy. They see the discount, they see the buybacks, they see the profit. But they're also just a little bit cautious about the execution risk.
The risk that this transition doesn't go smoothly.
Exactly. Or that something external throws a wrench in the works. Their guidance assumes fuel stays around 90 cents a liter. What if there's a war in the Middle East and oil goes to $120 a barrel? That changes the math fast.
So let's wrap this all up. Let's bring it home. We have a company that, by all accounts, had a fantastic 2025. They proved they could handle a crisis and still post record numbers.
They've successfully pivoted from just surviving the pandemic to being a highly profitable, growing airline. That's the big takeaway.
With a clear strategy that seems to be working.
A very clear strategy. Premium, international, loyalty, and cargo. And they're returning a ton of cash to shareholders.
So for you, the listener, if you're an investor, what's the bottom line here?
You're looking at a company that appears to be trading at a significant discount to its peers. You have a management team that's betting on itself with huge buybacks. But you have to be willing to ride out a year of heavy investment and rising costs. It's not going to be a straight lineup.
And if you're just a flyer or an observer of the industry?
You're seeing Air Canada really cement its place as a global superconnector. It's not just Canada's airline anymore. It's a major force on the world stage.
Here's the final thought I'm left with, a provocative question. Management has put this big, bold target out there for 2030. $30 billion in revenue and margins of 18 to 20%. That's a huge goal.
Very ambitious.
So 2025 proved they can make money. We saw it. They have the formula. But 2026 is a different test. It's about proving they can spend money wisely. They have to manage all this investment in new planes, new fleets, new labor contracts, all without letting costs get out of control.
It's a test of capital allocation. Can you grow the airline without getting bloated and inefficient?
And that leads to the big question for the stock. It's trading at levels we saw during the pandemic recovery, around $19, but the companies are posting record revenues and profits. Is the market completely missing the takeoff here? Or is it simply waiting for the turbulence of this transitional year to pass, waiting for the seatbelt sign to finally turn off?
That is the multi-billion-dollar question, isn't it? There's a wide gap between the company's performance and its valuation. And usually, eventually, that gap closes. The question is which way it closes.
Only 2026 will give us the answer. This was fantastic. Thank you so much for breaking it all down.
My pleasure. Always great to dig in.
And thanks to all of you for listening to the ProTicker Deep Dive. We'll see you on the next one.